Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, and I'm back. It's been a little while. It's good to be back. Adrian has been keeping the show going for weeks, even months at this point. So, Adrian, it's good to be back. How are you doing?
I'm doing great, Roshan. We're halfway through the year. Celebrated my birthday on June 1st. Happy year back. So I'm liking how the second half of the year is starting off so far.
Nice. How was the birthday celebrations? What did you do?
It was good. I just did like my favorite things. I went out to some restaurants. I golfed. I saw some of my family, some of my friends. So I definitely took advantage of it. And now summer's starting. So a lot of good things going on right now. That's for sure.
Yeah, that's great. Your birthday is definitely a good time of the year. It kicks off the summer, so to speak. We've got a great episode today where we're going to talk about mid-year market outlook. We're going to do this a little bit different than we have in the past. Hopefully, everyone enjoys it. So, Adrian, let's start off. We're recording this, as you said, right after your birthday in early June. What are you seeing with the market this mid-year? What are you thinking for the next half of the year?
So a good place to start is how the year went so far. And I think one of the biggest things that we can start on and touch on are just the equity markets. I mean, you saw a lot the first half of the year, especially with the volatility that we saw in the markets, where on average the major indexes were down 20%. I mean, that's just something you can't really ignore, especially as we're preparing and getting ready to see what we should do for the second half of the year. And a 20% correction in the major indexes is pretty painful. And again, there's a lot of things that go into it, but I guess one of the biggest headlines, which caused a lot of that volatility, is tariffs, which I still believe we're not completely out of the woods yet. But it's really something you have to think about as you're getting ready for the second half of the year on if you need to make any investment changes, what you should be planning for, and just how you can overall just perform better in the second half of the year. So I definitely want to start by touching on that. And I just want to add another thing on top of this, where in the first half of the year, something else that people were talking about and mentioning was this debate versus domestic versus international investing, where if your portfolio is very heavily concentrated in the United States stocks, companies, you probably saw a little bit underperformance compared to international markets. For example, let's talk about Europe, Japan, whose markets did pretty well. So there was a big debate going on. Should we start moving some of our investments, some of our positions to more international because they've been performing well? So I think that's also something too I'd like to talk about in the subcategories of equities right now for the mid-year market outlook.
Yeah, so tell me what you're. There's definitely a lot of talk about international outperforming the U.S. And I imagine that's still the case at this point. I haven't seen as much about that recently as I did earlier in the year. Did you look that up to see? I can check this out right now as well. But did you look that up
Well,
to see?
Well, I think it's more of just for our listeners and viewers, a little bit of just like a wake up call. Just again, if you were somebody that was over allocated to United States stocks, United States equities, and historically those have been performing well relative to international stocks over the past couple of years. This is a year where it was a little bit different, where you're like, wow, okay, maybe I'm underperforming because some of these other portfolios, these other strategies that were tilted a little bit more to international or globally diversified have been doing well. So I think that's, again, a good starting point for our mid-year market outlook, where this is a good point where you check in, see where you are right now, see where you're allocated. Sometimes when we talk about diversification, we just think about stocks, we think about bonds, we think about cash. But this is really tied more into that equity portion and diversifying. Not only do you look at diversifying with different sectors or industries, but now I think a lot of people recognize not only do I have to be diversified in that sense, but also on a more international or global way, just to see if I can perform better or protect some of my downside in my portfolio going forward in this year. I think that's the first bit of advice I would have with this second half of the year as we're approaching it.
Yeah, and I was curious as you said that, so I did look up the numbers on this, and two things stand out to me. So let me give our disclosure first. This is not market advice at all or recommendations. This is simply research. Do your own homework. Look into these any ideas you like on your own. and come to your own conclusion there. So what I did was I looked up the iShares MSCI EAFE ETF. That symbol is EFA. And year to date, it's up 18% versus the S&P being up just under 2 at the time of our
Wow,
recording.
that's huge.
So
Yeah, that
it
is.
is, and so my initial thought was then, is it too late? I don't have an opinion or a stance on that. As I said, I'm just looking up right now. But then I just expanded that view and said, all right, give me a 1 year view. And over the last year, the S&P is up 13.07, and that international index is up 9.85. So
Mm-hmm.
a believer that that uh, if you're a believer that there's an opportunity in international, I would say it doesn't appear to be too late. But I that's simply by looking at a chart for 30 seconds. So I would definitely encourage you to do your research and analysis. At this, I personally don't have an opinion on it, but the two charts that are giving us real factual data. One, that index has definitely outperformed the S&P in 2025, but two, if you look at the last 12 months, it has not. So it might be worth the time to look into.
Hmm. Yeah, exactly right. And another thing I just want to touch on with just the equity portion of this podcast today is again, it was a little bit of a whipsaw this year because again, we were down around 20% on the year and we've recovered most of that already in a short amount of time, which just shows you how markets can really swing and the timing of it is just very difficult as well. And tying a little bit back again to the debate of domestic versus international investing, I think one of the major things too, just driving that comeback in the United States with the market and whether that will continue the rest of this year is artificial intelligence. That's still a very prominent portion of the market right now, experiencing some of the big gains. I mean, one of the biggest things that people were concerned about in the first half of this year was the Magnificent Seven, which was underperforming, but now it's starting to come back a little bit more right now, where you're starting to see, since we actually had the first round of earnings come out, which people were really nervous about, but they turned out to be a little bit better than expecting. Not great, but still good for the most part, considering everything that was going on. You are starting to see that artificial spending in the artificial intelligence space starting to make companies more profitable. You're seeing, stock prices starting to rise, and I think this is another good place to start too when you're planning the rest of the year. When people are thinking about artificial intelligence, they specifically start thinking about the technology space. Do I need to allocate more to the technology space? Well, what's interesting is this first round of earnings showed that artificial intelligence is helping out some sectors that aren't fully just technology. You're seeing the financial sector, industrials, even energy companies now with nuclear starting to try and be the forefront of fueling artificial intelligence is starting to experience some big gains. That's something too that you got to think about going to this year where you're like, hey, maybe I want to start investing more in artificial intelligence. Maybe that can continue to do better. Don't just immediately jump to, wow, that's going to be technology. You're starting to see it in other sectors, a little bit more of a broadening out, which we talked about a year ago today. So I think that's also something too that our listeners and viewers just need to be aware of too. That's going to be something that's going to be on top of investors' minds.
Yeah, what's interesting is I was listening to a podcast where earlier in this year there was speculation that is the artificial intelligence trade, so to speak, over, and there were a lot of bearish sentiment out there, and that was January February timeframe. You fast forward to June, and all the numbers are indicating that there is still a big opportunity there, right? Like you'd mentioned the power deal. Meta just signed a big deal, I believe it was with Constellation Energy,
Yes.
for getting their power source. And what stood out to me was it's a 20-year deal,
Wow.
right?
Yeah.
So
Mm-hmm.
it's if you're someone who thinks this AI is a short-term trend that'll be here and gone, um, I would tell you Meta is putting their money where their mouth is and saying that's not the case. I'm not a believer that it's a short-term trend. This um, reminds me a little bit during the pandemic when people started looking at actually, when Facebook changed their name to Meta, there was all this talk about the metaverse and this platform, and I was not a believer then, and that definitely crashed and burned a lot. Now with AI, I definitely personally am a believer. Think that it has legs and it can be very transformative. The technology can be transformative. There's definitely stuff I've read where there are pharmaceutical companies that think they'll be able to more efficiently come up with uh, cures, drugs that can help people with the use of AI. All the stuff that we're already seeing and using, where there are these chat bots out there where they'll take care of doing some customer service duties. Um, so there's there's definitely a place there uh, that will really change businesses. I there was listening to another uh, podcast about a financial services a company that provided financial data that now said almost all of their code is written by AI, when 5 years ago it was none. So that there are a lot of places where there are opportunities for AI to really be transformative to businesses, and and I that's my personal position. I think there's a huge opportunity there, but time will tell for sure.
During this kind of wave of AI too, I definitely always like to just continue to look at valuations, which haven't really got too out of whack or extremely high, where a lot of these companies are backing it up with earnings, and you're seeing it again on these quarterly calls as well. So that's something too that I'm very critical of as well, because once valuations get really high, that's when I start getting a little bit concerned in the space. But you're not really seeing that. And again, at the first half of the year, it was again a very big reset of investor sentiment, where again a lot of these companies that did well the past 2 years came back down. It's kind of big reset. Okay, what are they going to do? What are the earnings calls going to look like? And now that we got through it, we've got a little bit more clarity, but again there's still some uncertainty around it. But again, we'll just see that as this year comes up. But just seeing where you're over allocated is something that you really need to see going this year, because if you think, I'm not comfortable with these valuations, I don't think this AI trend is going to continue, then that's something that you have to make a decision on. So again, I think we did a good touch on the equity side of our mid-year market outlook. Is there anything you want to add before we move on to the fixed income and bonds? Because I think that's too is something that our viewers and listeners are going to want us to touch on, just to see what our kind of outlook is in that space going forward.
Yeah, well, you mentioned this. I just think it deserves a little bit more time. You had mentioned the tariffs and how that's
Yes.
impacting things earlier this year, and it's just worth noting as we record this in June that Trump's 90-day pause ends in early July for the European Union. It ends on July 31st for most countries. For China, it ends on August 12th. So I think we're going to see market volatility going into those time periods. And we may have already, and with the volatility, I do mean on either side. What I up or down, right? If there are some good deals that come through, the market will shoot up. If the date comes in and there aren't deals made, you'll see a decline in the market. So I do think, as we speak of uh, the second half of the year, that's a big factor. What's going on with the tariffs, just like it's been the first half of the year. The other thing that I imagine you have on the bond area, so I won't spend too much time on. Well, let me just ask, or maybe this will be our transition into the bonds. Interest rates and the Fed. Is that
Mm-hmm.
on your list as you shift over to the bond market?
It is. And I'm really glad, again, super hype you're back on the podcast, Roshan, because I was going to move on to fixed income, but there's something else I wanted to talk about, the equity portion that you reminded me of. So you talked about tariffs. They're delayed, but they're going to come back into the market, and that's going to be a headline soon enough.
Mm-hmm.
So one thing, too, that's being discussed a lot is, again, let's just say the markets just shake off the tariffs, they do well, markets go to new high, record highs, great, everything's fine. But one thing you're hearing people talk about is we could be range bound, or the markets could just be choppy for some time. We don't know if that's the case, but that could be a very big possibility. What do we do? So again, this is going to get a little bit more complicated, this discussion. And again, this isn't investment advice, but one strategy people are talking about now, if choppiness continues in the market and we're range bound for some time, but there's increased volatility, is covered calls are starting to become a forefront of what people want to learn more about right now. And you could probably do a lot better job explaining covered calls right now, but my simplest way to describe it is it's a way to generate income on your investments or your stocks. But you have to consider you're selling some of your upside. You're basically saying if my stock or my investment goes above a certain price, I'm locked in at a specific price and I have to sell it, regardless of how high the stock goes. And you're willing to do that because you collect some income. And the reason why covered calls are being talked about a little bit more right now, because again, if the markets are choppy or staying in range bound, again, your portfolio might not be going anywhere, but this is a way for people to generate incomes. And as we know, this is an option strategy. So there's a lot of risk and a lot of discipline, a lot of strategies that you need to really consider before you do this. But this is also something that you may want to look into to just kind of maybe generate some income, protect your downside if you do believe there are choppy markets or a lot of volatility, because also covered calls get talked about as well. When there's increased market volatility, the premiums increase. What that means is that income that you are collecting may increase because of the swings in the market. But again, that's another layer of risk. So that's something else I wanted to talk about in our equity portion, because I know that's something that people might read about or research or learn about for the second half of the year, if that's their belief.
Yeah, I think you did a good job giving an overview of covered calls, and that would be a great strategy in a choppy market. I will give a little bit more detail on the explanation. So, hypothetically speaking, keeping the math simple, you own stock in company A and it's trading at $100. Well, what you can do is sell a call option, which means you're selling someone the right to buy that stock from you. And let's just say, for this example, you have to sell it at 105, right? And I'm just giving complete estimates. Well, you might get, for that selling it at 105, you might get like 25 cents a share. So you get to keep that, and you've got to do it in 100 share increments. So let's say you've got 100 shares of this stock, you get the 25 cents a share or 25 bucks right now in your account. What you're giving in exchange for this $25, as Adrian said, is you now have the obligation to sell it if it goes above 105. So that's what Adrian meant by you're capping your upside. Now, the range bound piece he mentioned is if the markets are choppy where they're going up and down, but not really in either direction that significantly, they stay within a range. Well, in this example, let's just say the stock you own for company A is trading between 95 and 105. Well, or let's just say 104 for this example, between 95 and 104. Well, then you're just collecting this 25 bucks on whatever frequency. So an option has a strike price. In this example, that's 105. And it's got a premium. In this example, it's the 25 cents per share. And it's got an expiration date. So in this example I'm giving, let's just say it expires every week. Well, you're getting 25 bucks every week. And if the stock never exceeds 105, you get to just keep the $25. So that's where Adrian's example of a range bound market, once again, staying between 95 and 104 for this hypothetical stock, is good for covered calls, because then you're just collecting the income. Whereas if the market is shooting straight up, well, you potentially have to sell your stock at 105, and let's say it shoots to 110. In order to get the 25 cents, you lost out on $5. Or the opposite, if it goes down, you still collect the $25, but you're losing money on your principal. So if it stays within that range, you're able to keep your principal secure and collect income. So yeah, Adrian, in a range bound market, I completely agree. That is a great opportunity.
Yeah, and like you mentioned too, that income can just help If the markets do start to pull back, again, like we said, in the first half of the year, we experienced like a 20% correction. Well, if you were collecting income during that whole time, maybe you're not down 20%. So that can help you a little bit on the downside. But that's something too, I'm glad we talked about and explained, because again, that could be coming across some people's radar going to the second half of the year. And that's something too that I'm glad we touched on as well. Anything else that you want to add before we move on to the fixed income portion, which I know our viewers and listeners are definitely going to want to hear our opinion about, especially with the current interest rate environment and everything that's going on with bonds right now.
Well, nothing else on the equities, but a lot of times what's going on in the bond market will drive what's going on in the equity market, because the bond market is a little bit bigger than the equity market. So a lot of talk is devoted. CNBC is always talking about equity market, etc. And I just looked this up. The global bond market is estimated at 140.7 trillion, while the global stock market is 115 trillion. So that makes the bond market about I believe this says 22% bigger. So a lot of times, and I've definitely seen and heard this a lot this year about how the bond market will drive the stock market. So even if you're not a big bond investor, you focus more on equities, having knowledge of what's going on in the bond space will definitely be helpful to you.
Yeah, I definitely agree. And again, with this current interest rate environment, you are seeing pretty good rates, whether it's on short term bonds, whether it's money market funds, CDs right now, they are still paying you to lock in those or invest in those certain investments, and the rates are pretty good. Where it starts to get a little bit complicated as you go farther out and you lock these bonds longer out, where the yields are still pretty good on them. But again, that's just an area of concern right now with just everything that's going on with this current interest rate environment. Because again, we don't know what rates are going to do. Again, a lot of that's driven by what the Federal Reserve is going to do. One of their biggest focuses on is what's going to happen with the labor market, what's going to happen with price stability. That's all the stuff that mainly drives the bond market, and that you just need to be aware of, especially if you're trying to build the classic 60-40 portfolio where you're allocating 60% of your portfolio to equities, to stocks. That other 40%, you're going to really have to look at and see how you're going to be more tactical with that going forward this year. Because if you're invested in short-term bonds, that's great, but when they mature, you might not have that same opportunity that you had before, depending on where rates go. And that's something too that I think is, like you mentioned, the bond market is huge, and it is a big driver on the equity market. And one of the biggest concerns people had this year was that downgrade on US Treasuries. I mean, when you think about, when it comes to one of the safest investments, you think about the US Treasuries. But the fact that that's got downgraded again, there's deficit concerns right now. There's a lot of risk out there when you talk about bonds. When you think of bonds, that's like the safest portion of your portfolio, but that might not be the case. And I guess that's what I really want our listeners and viewers to really understand: the risk that is associated out there with bonds right now.
Yeah, you know what's interesting? I do remember when this happened in 2011, the U.S. Treasuries actually went up in value. So people were flocking to quality, so to speak. And as you mentioned that, so this downgrade was a Moody's downgrade, and in 2011, S&P downgraded the U.S. bonds, and 2023 Fitch downgraded the U.S. bonds. So Moody's was the last of the big three agencies to do so. The thing I am curious about is which way have the long bonds gone since then. So that was on May 16th. So it's not quite a month ago, and I'm just going to see which way the bonds went since then. So May 16th, I'm going to, let's go with the May 15th close.
Okay, yep.
And May 15th close uh, to where it is right now, and I'll give you the number in one moment. But it's not as big as you would think, as I'm So, on a price basis, the long term US bonds have gone down by 0.3%. So, I would say they're essentially flat in that time period. The only reason that I think about that is because I just remember in 2011 when this happened, which was the first of the downgrades, that treasuries went up. So, and if you just think about that for a moment, treasuries were considered and still are considered the risk-free asset when we run calculations. So people got scared that the US debt got downgraded, so they sold stocks and bought US debt, right? Which is definitely counterintuitive, right? I would say. So I was just wondering if the same thing happened this time. It didn't. The debt did go down, and once again, when bond prices go down, the yield goes up, which makes sense. If you're lending money and all of a sudden you've been told that the loan you're making is a little riskier, what do? You demand a little more interest. But the fact that the move was as small as it wasn't surprising to me after what happened in 2011, but um, it's not exactly in line with what you would expect.
Yeah, exactly. And I think the last thing we're going to add to this as well is corporate bonds as well. That may be something else that you look to as well with everything that's going on with U.S. Treasuries. But then there's another risk aspect to that where it comes to credit worthiness, where you'd have to rely on the credit of a specific company to back up those bonds that you're buying. But again, you can say, well, the US Treasury, I have concerns about that right now since it was downgraded. It really is just another conversation of diversification as well, with this 40 portion, going back to the 60/40 of your fixed income and bond portion of your portfolio, if that's how you're allocated, because there's a lot of different things that you have to look at. And again, you can't just rely, hey, this 40 portion of my portfolio is going to protect me on the downside and help generate income. That not may not be the case if you're solely in long-term bonds or short-term bonds. If you're in bonds that are solely with one corporation or spread out across many, or just in U.S. Treasury, there's a lot of different ways you have to look at it. Is exactly why we're talking about this today and what you need to look out for the second half of the year and as you prepare for that.
Yeah, one thing I will mention that I believe is worth noting. Earlier this year, I did an analysis on bond funds versus bond ETFs. And this, I think, is worth if you're getting your bond exposure down this using either of these securities, ETFs or mutual funds. I found that there was a lot of outperformance with the mutual funds. Mutual funds people sometimes don't like because they are more expensive from a management fee perspective than the ETFs. But if you're looking for a bond, how to invest in bonds, and you're considering a pooled asset like an ETF or a mutual fund, I would encourage you to do the comparison and look at both. The other thing that you mentioned earlier, Adrian, I want to just highlight further, and that's you had mentioned losing the opportunity. And so the way the bond yield curve works is you get a certain rate for 1 year. It's a comparison. What do you get for 1 year, 2 year, 3 year, 5 year, 10 year, and going on out? And an inverted yield curve is when you get a little bit more for the shorter term than the longer term. And um, and so what you're seeing is that you are getting a little bit more in the shorter term than the longer term if you look at it in general. I'm actually going to look at the yield curve right now to confirm that. But so I'm looking at the treasuries right now, and right now the 3 month treasury is at 4.35, the 1 year is at 4.162, and then the low is the 3 year on this yield curve right now of 3.89. Then it starts going up. The 5 year 4.024, the 10 year 4.44, the 20 year at 5.022, 30 year plus at 4.94. So what Adrian had said, I know it's a lot of numbers, but the 3 month treasury is paying you 4.35. And then in order to eclipse that, you've got to go all the way out to 10 years where it's 4.41. And let's go a little bit more narrow because I think that'll help explain this a little bit better. The 3 month is 4.35, and then the 2 year is 3.947. So why are you getting less for a 3 year, for the 2 year? Excuse me, I use the 2 year of 3.947 this example. Why are you getting less for the 2 year at 3.947 than the 3 month of 4.35? Well, the bond markets are basically saying they think rates will be cut. And I think the explanation when you get further out, and here I'm I'm sort of guessing this, but I think when you get beyond 5 years, where the 10 years at 4.411, which is better than the 3 month of 4.35, I think what the bond market is saying then is beyond 10 years, we really don't know, right? So what Adrian, you mentioned earlier about opportunity cost with these treasury numbers is, as an investor, if you're getting a treasury bond, should you take the 1 year that's paying 4.162, or the 2 year that's paying 3.497? You would probably naturally think um, that you take the 1 year, because 4.162 is higher than 3.97. But what you're missing, if you keep your analysis that simple, is what Adrian said. It's the opportunity cost. After 1 year, what will you be reinvesting this bond at? What rate? And right now, what the bond market is saying is that there will be at least, so the difference between the two is 0.215. I'm multiplying that by two because it's 2 years. And what the bond market is saying is there's likely to be 1 to 2 cuts in the next 2 years, because theoretically you should earn the same amount in either time frame. So when you're looking at, and this was on treasuries, but CDs, corporate bonds, they all will work with a similar yield curve. So it's really worth considering, based on your time frame for investing, what the rates are, etc. Don't just look at what the higher number is. Make sure you consider the time frame, and then you've got to have an opinion on what you think will happen with interest rates as well.
I mean, that's what every investor is really looking at, where are rates going to be headed into the future? Because, again, it just has such a significant impact on that fixed income portion of your portfolio. So I definitely like our conversation here. There is just one more subcategory I want to touch and include on, but is there anything else that you want to talk
Yeah,
about on the fixed
just
income portion?
just to add on the interest rate thing, what's pretty interesting right now, with what's going on with the markets, is you've got the president telling the Fed to cut rates,
Yeah, a lot
and
of
the Fed,
pressure.
yeah, and the Fed is basically coming back and saying these tariff policies are inflationary, so we're going to wait and see. We're not gonna cut rates. Now, what you're seeing though is you're also seeing inflation has been declining, right? So there have been a couple signs of weakness in the job market. Nothing that I think will force the Fed to act that quickly, but uh, that the data set might be too small, right? And what I mean by that is, what happens with tariffs? When there are tariffs, that gets passed on to consumer, and inflation goes up. That's what's expected. That's what traditionally happens. Now, we haven't had the tariffs for long enough, so maybe it has not happened yet, and it's going to. But inflation's going down. I believe that has to do with the consumer cutting back on spending, the consumer being concerned about a recession, and cutting back on spending due to that. And so, and it could be the other side of it, where the consumer just doesn't have as much money as they did. A lot of the money that was saved up during the pandemic at this point has been spent. So for whatever reason you believe the consumer isn't spending as much, and you're starting to see a slowing of inflation, even though these tariffs are out there, which is typically inflationary. And then you've got the Fed I think if the inflation numbers were where they are currently, and employment was where it is, and there are no tariffs, I think the Fed's making some cuts in this kind of environment. So it is a very difficult time to gauge. The Fed has always said, "Hey, they'll be data dependent" previously, and uh, but they do have to look at what's going on. So I'm not necessarily faulting them, or taking an opinion that they should be cutting or shouldn't be. But the what makes this interesting is the data is suggesting cuts. However, the overall fiscal policy right now is suggesting wait and see. So it becomes more difficult to predict which way it's going to go, because it's either A, not enough time, or B, we're having something that's just not what typically happens. And things that don't typically happen still happen sometimes, right? So that Fed inflation versus rate cut, I think that'll be a strong theme in the second half of the year. And the tariffs will be a strong piece that'll drive that as well.
Yeah, it's just like a future battle that we're all on the edge of our seats for, fiscal versus monetary policy. And hopefully it just doesn't get too messy in the second half of the year. But again, it's just a lot of uncertainty just around that right now. But it'll just definitely be interesting to see what happens. And if that's definitely concerning, seeing what changes or adjustments you got to make so you're better prepared for that if it doesn't go the best way possible.
Yes, agreed. All right, Adrian, I'm sorry I keep slowing you down. You had one other item you wanted to cover, you said.
Yeah, I'm going to call this last category the three C's. It's going to be currency, commodities, and crypto. And I can see one of our listeners or viewers right now fall out of our chair and be like, "Oh my gosh, crypto, our currency right now. Why are you putting that in a separate category?" But again, I just want to talk about currencies, commodities, and crypto. I think that's probably another thing that people are going to be looking at in the second half of the year. I'll just give a quick overview right now. With currencies, I think one of the things people are seeing about or reading about, specifically with the dollar, that it's starting to weaken, and that's very concerning out there. Whether you're an importer or an exporter, whatever the dollar does, or if you travel overseas and you're converting your money, whatever the dollar does in relationship to other currencies is very significant and can have a very big impact on the consumer and businesses and sectors and industries. And then if you look at commodities, that's something too that people sometimes look at as a hedge right now, or another allocation in their portfolio to keep pace with inflation that doesn't really get impacted by what the bond or the equity market does, and acts as a little bit of a negative correlation to their portfolio as well. Where again, you did see in the first half of the year and last year, where specifically one of the commodities, gold, did very well as an inflation protection hedge, or doing well when the markets didn't do well. And then lastly, crypto. Again, that's also something too that a lot of people look at, the big swings in that, the potential for it. Whether that should be or shouldn't be another allocation or a tactical sleeve of somebody's portfolio as well, is something too that people may look at the second half of the year. So however you want to tackle this, but I think it's just something worth having discussion on, the three C's: crypto, currencies, and commodities.
Yeah. And so your first one on the three C's was crypto, correct?
It
It's
was
crypto.
currencies, but I know
Oh, it's
some people are
currency.
like, talk about crypto first, please, Roshan. I like that. That's
Well, no,
exactly what I want to hear
well, no,
first.
I just no, I wanted to line it up with what you're saying, because I actually think there's something really there's a lot of interesting things at play, and they definitely interact. So
Mm-hmm.
first, currency wise, the dollar has weakened significantly this year, and I'd have to look back at the numbers to see. I'm going to do a rough calculation. I'm comparing it currently to the euro. So where we stand right now, the dollar's down over 9% versus the euro year to date. So we're seeing some weakness there, and a lot of it kind of makes sense if you think about what's going on politically. You think about the rate cut we talked about, the tariffs, some isolationism. It sort of makes sense that the dollar has been weakening. Now, I'm not a currency trader. I don't follow it very closely, but I did happen to hear an interview a couple days ago with a currency trader who is predicting that things will start to turn. I don't know if that's going to happen or not. I this was I mean, I think it was yesterday or the day before. So there hasn't been enough time yet for that for to say they're either right or wrong. In my opinion, it's just not enough time yet. But it's just an interesting data point that we've got someone predicting the bottom on there. Next, I believe was commodities. You mentioned this already, but I'll touch on it further. Is gold has done really well this year, right? Year to date, gold is up at where we talk right now. The gold ETF GLD. Once again, not a recommendation. Do your research. I'm just giving you data, but the gold ETF is up 26% right now year to date, doing way better than the US stock market and doing better than the European stock market, which we talked about earlier, how that was doing better than the US stock market. So you are seeing gold do well. I don't know if that'll continue or not. Similar to saying earlier, I don't really trade or research currencies. Same thing for commodities with gold. Um, Now, the last one that you said on there that might have people more interested is the crypto space. To me, this is very interesting this year. And the reason I find crypto very interesting is uh, a lot of the talk on crypto, and let me get more specific on Bitcoin. Once again, not a recommendation, just where there's more data and there's more research and analysis. But a lot of the talk with Bitcoin, or a lot of the people that are very pro Bitcoin, will say how it's an alternative currency. It's there if they're for to protect us against inflation. Well, if the U.S. government's going to be printing money, uh, and there's going to be these this new I think it was the big beautiful bill that Trump has in there. If that goes through, you have an increased deficit, you're going to have increased spending. That would give us an inflationary environment that would that the pro Bitcoin people would tell you is a very good environment for Bitcoin. The other thing that's interesting is I wonder, Bitcoin has very much traded like a risk on asset, right? And what I mean by that is when people have an appetite for risk, you would see a lot more increase in flows into Bitcoin, and Bitcoin's value go up. And it was what I wonder, what's so interesting this year is I wonder if there was a little bit of a shift this year from Bitcoin being a risk on asset to is Bitcoin now really this inflationary or alternative, inflationary hedge slash alternative to gold. And I don't know if this will be the case, only time will tell. But you did see a little bit of separation in April in that Bitcoin versus the NASDAQ chart. So this is more of a curiosity than anything else to see if that's actually is that actually going to happen, that this whole separation. And once again, will if it does prove to be a gold alternative and the government is spending, is that an opportunity for Bitcoin? You also have ETFs available now, which you didn't before. So there's easier and more access. There's institutional access. So there's a lot going on in that story. So I'm not necessarily trying to take a side on it. Just share data and say, yeah, do your research. I just find uh, the whole conversation and just observing what's going on incredibly interesting. And I think this will be a good story to see how it pans out. But the people that are very pro crypto and Bitcoin, if they are right, I think we're starting to get a market that is set up really well for the opportunity there. Once again, that's if they're right, and I will follow up with do your own homework on this and do your research.
Yeah, exactly. And then you're seeing big institutions starting to allocate to it, funds starting different products out there for it as well. So that's also something to follow and see if that trend continue. And the thing that again I'm just having a hard time grappling with when it just comes to crypto is just really it seems like every year it really changes on how it incorporates into somebody's portfolio. Again, let's just touch on the 60/40. And if you want to allocate, again, a portion of that to crypto, and again, what role is it going to play? Because sometimes it could be a hedge where if the markets are going down, some years crypto may be going up, or the opposite. And that's just something too where we'll see as the years goes on and how that allocation approach may change or how we'll incorporate as well. And that's something too that I thought was worth just having a discussion on, because I know we'll probably have futures discussion on it as well.
Well, Adrian, that's exactly what we talked about in our previous crypto and Bitcoin episodes, where a lot of the argument that crypto and Bitcoin were different from other asset classes, part of it was that this was the first place where individuals could get in before institutions.
Mm-hmm.
And now you've got institutions that can get into it, as you had just indicated, and are potentially allocating to it, which could be another driving force for it. So interesting story. And even with this crypto, I'm not in this camp, but you still have people who will give you the story of it's just for a story that's been debunked, I believe personally, but the story that, oh, this is just for criminals and stuff like that, and I believe that the loud voices in the room that were saying this aren't saying it as much as they used to, but you still have people to believe it. That to me, and the institutional side, makes me feel like it's at the very least worth spending some time to research, right? Is there an opportunity there? And I put it that way because I think a lot of people, if you look at a chart of Bitcoin, for example, will look at it and say, well, it's too late. And I think that's the other side of it, of if you believe it's too late, fine. If you don't believe it's too late, you have this opportunity still out there with the institutions continuing to adopt, and with there still being people out there that are really against it. So that to me, that's just really anecdotal stuff to indicate that it is still relatively early, even though it's been around for 20 years and has Bitcoin has eclipsed 100,000. Right?
Mm-hmm. Yeah.
It still could be early. So once again, not taking a stance, giving you data. Please research, do your homework. But the useful information I see there is it may not be too late, so it's worth researching. A, and B, it's readily accessible now, which it wasn't just a few really months ago.
Mm-hmm. Yeah, a better favorable regulatory environment as well was a big challenge, but you're starting to see that being more of a pro now in that space too. So that's something to follow as well with the crypto space.
Yeah, I think that was a big part of the run up in it, prior to and immediately after the election, right? Where you've got an administration that is definitely more favorable, to say the least, for Bitcoin. So, Adrian, I believe we covered the last item in your on the list with the 3 C's. Did you have anything else for your mid-year outlook that you think is worth reviewing or discussing?
I think we touched on all the main points. We talked about the equity market, fixed income, crypto, currencies, commodities. I think all of these are going to be something that investors are going to have to look at, research, and see if this is something that they need to make changes to, or updates, or adjustments, or allocations to, as we're in the second half of the year right now. And again, there's going to be a lot of things going on with earnings seasons, these tariffs, legislation. So you're definitely going to be faced with a lot of information, a lot of news out there, and the way you handle, respond, and do your research into it is really key, just so your portfolio and your investments perform well over the long term.
Schedule a conversation with Roshan, Adrian, or Eric today at retirementlifestyleshow.com. Roshan and Eric are certified financial planner practitioners. They, along with Adrian, are investment advisor representatives and serve clients across the U.S. with financial planning and investment advice through Arete Wealth. If you found this show helpful, gained knowledge, or enjoyed the time you spent with us, tell your friends and leave us a 5-star review. This will help others discover the show. To access our show notes, to download any of the tools mentioned in today's podcast, to ask us a question, or to schedule a conversation, go to retirementlifestyleshow.com. All opinions expressed by podcast hosts and guests are solely their own. While based on information they believe is reliable, neither Arete Wealth nor its affiliates warrants its completeness or accuracy, nor do their opinions reflect the opinion of Arete Wealth. This podcast is for general informational purposes only and should not be regarded as specific advice or recommendations for any individual. Before making any decisions, consult a professional. The show hosts offer investment advice through Arete Wealth Advisors, LLC, an SEC-registered investment advisor, and securities through Arete Wealth Management, LLC, member FINRA, SIPC, and NFA. Finally, our music is The Chance by Jason Shaw and Audionautics. It's part of the YouTube audio library, and it's licensed under a Creative Commons license. I am Ray Voices. Thank you for listening.